Welcome everyone, and thank you for joining today's webinar, Beyond Compliance, Unlocking Business Value Through ASRS and ESG Data. I'd like to begin by acknowledging the traditional owners of the land from which I'm speaking to you and the traditional custodians of the land of which each of our online attendees are living and working. I pay my respects to elders past and present. Hi, I'm Christine Chintelfanti. I'm the Marketing Manager at DataESG. I'm joined by our presenters today, Roger Mills, DataESG Manager of Sustainability and Social Impact Strategy. He is a researcher, consultant, and project manager with a passion for environmental sustainability. Also joining us is Shu Setagawa. He is the Director of Sales and Business Development at ASUENE. He has a deep understanding of the role of technology in management, analysis, and reporting of emissions data. A little bit of housekeeping. We encourage that you all engage with us today and ask questions. You can post your questions in the chat and Roger and Shu will answer them at the end. I'd like now to hand over to Roger and Shu. Over to you guys.
All right, thanks, Christine. And I'm coming to you all from Gadigal land on the Eora Nation here in Sydney. Look, welcome everyone. This is the third in the series of webinars we've been doing this year. And we chose this topic really as a natural fit to the previous sessions, which covered ESG reporting, frameworks and compliance under the NGER, or the National Greenhouse and Energy Reporting Scheme. But today we're going to focus on ASRS and the advantages of compliance and how it can actually increase your competitive advantage and business value. ASRS, for anyone who's a newbie here, is the Australian Sustainability Reporting Standards, and of course ESG being environmental, social and governance. I'm going to kick us off with an overview of ASRS standards and how companies are using ESG data to really increase their business value through 2 case studies I've prepared. I'm then going to hand over to Shu, who's going to talk to ASUENE's decarbonisation software platform and how that can assist you in developing further business value. But by way of an introduction to DataESG and ASUENE, DataESG are an Australian company focusing on ESG consultation services. We do things like research and development of sustainability strategies, ESG data management technologies, assisting both local and international businesses comply with mandatory climate-related disclosures, the whole gamut of ESG-related activities. ASUENE is our key technology partner and also happens to be Asia's leading decarbonisation platform with 10,000 company users worldwide, and as you see later on, and to our knowledge, is a really comprehensive software solution with AI-powered features, and which really provide quite a holistic solution for utility, emissions, and supply chain management. And I'll leave Shu to talk to you further about that when I hand over. But we thought we might just introduce a bit of fun here, just by starting with a poll about how you feel your current sustainability policies are providing your organisation with a competitive advantage, or not, if the case might be. So let's let Christine bring that up for you.
Okay, so you should just see a poll now. So please answer that and submit your vote, and then we'll start to collect the stats. Okay, I'll just give it a couple of extra seconds. Okay, so we have 82% yes, 9% no, and also 9% saying that we don't have a sustainability policy.
Oh, that's interesting. Well, hopefully by the end of the session, we'll be able to provide you with some thoughts and ideas as to how you might increase those levels for those who reported no there or don't have a sustainability policy. It is really worthwhile to start thinking about that. But look, before we get on, let's first remind ourselves, particularly for the newbies here as well, about some of the history about how we actually got to the ASRS standards through what we call the ISSB, the International Sustainability Standards Board. Compared to financial accounting and reporting, sustainability reporting and GHG accounting really are pretty relatively new concepts. The GHG gas protocol that defines how to actually calculate your emissions was launched just 24 years ago, which in the scheme of things isn't that long ago. Of course, you then got the CDP, or the Carbon Disclosure Project, was established in 2002. There's obviously now a global platform for climate disclosures between companies and investors. Also, after that, you had the Paris Agreement in 2015, and we really saw an accelerated adoption of climate-related frameworks, and the emergence of additional ones, such as your SBTI, the Science-Based Target Initiative, TCFD, and now thousands of companies around the world are now engaging with these frameworks. For example, in the EU alone, the CSRD, or the Corporate Sustainability Reporting Directive, was adopted, and that's now affecting more than 50,000 businesses operating in Europe. Which ultimately affects their supply chains outside of the EU, and particularly in Australia. But what we've done here is really, with the ASRS, specialize these frameworks to really suit the Australian standards. So let's have a look at the ISSB, which was developed through the IFRS. There's a lot of acronyms in this business, as those in the know on this call will testify to. The IFRS being the International Financial Reporting Standards, really to standardize sustainability reporting internationally in line with financial reporting. So its key reporting pillars are being governance, around managing climate risks and opportunities, strategy, strategizing actual and potential business risks and opportunities, risk management, how business identifies, assesses, and manages those climate risks, and importantly, the metrics and targets, the data used to assess and manage climate risks over time. And these are really, in terms of the changes that have occurred, the emphasis on Scope 3, the supply chain emissions. I mean, whatever size company you are, you're likely to be part of someone else's supply chain. We also got the transition plans for Scope 1 to 3 emissions, the importance of the value chain strategy, industry-based guidance and third-party assurance and verifiability to be mandated. Potential impacts of these, more companies requesting carbon reports from their supply chain partners. Some of you may well already have engaged in tracing your supply chain and requesting that information. Decarbonisation, targeting impact procurement decisions, credibility in terms of the accuracy of reporting, could be questioned if these other pillars are not met. And all of this then feeds into the development of the ASRS, which comes through that IFRS foundation. So it's all about integrating this reporting, integrating these different world standards, and adapted for Australian use. So both the IFRS 1 and 2 frameworks have developed, out of which have developed AS S1 and ASB S2. So just some of the difference between these two: AASB S1 is a voluntary standard that entities can elect to apply. It uses these four pillars. In fact, both of them use these 4 pillars. Doesn't require an entity to provide information about every sustainability-related risk and opportunities. It's really a basis to start with. Requires an entity to disclose only the information about sustainability-related risks and opportunities that you would reasonably expect to affect your prospects. There's cash flows, access to finance, capital, and short and medium term, and long term. If you're interested, there's the full range of ASRS standards through the portal there, if you want to use your phone for that QR code. Then we move to the ASB S2, mandatory for entities meeting at least 2 of the 3 criteria that we'll have a look at shortly. It really requires an entity to disclose its absolute GHG emissions, as well requiring entities to use climate-related scenario analysis to inform your disclosures, providing information about the assumptions that you've made in terms of creating that scenario analysis to enable investors to understand your disclosures and the related methodology. Also requires you to provide information about scope 1, 2, and 3, and particularly for financial institutions with activities in asset management, commercial banking, insurance, etc., required to disclose information about your financed emissions. These are emissions that you're actually financing by lending money or providing money to others. So hopefully that was an overview of the differences between those. So there's many more, and you could do, in fact, a whole series of webinars just on the AASB 1 and 2 alone. So here's just a look back on the reporting groups. So obviously your reporting group 1 started from the 1st of January this year, and you're coming up to 31st of October, which is the deadline for submitting your report. So you'd be in that 500 million revenue, 1 billion consolidated assets. Then you got your group 2, starting from July next year, your 200 gross revenue, 500 million consolidated assets. And again, either number of these employees as well can also feed into any 2 of these criteria. And then finally, you got your group 3, which would be required to report after the 1st of July in 2027. So there, now your SMEs with turnovers up to 50 million or 25 million consolidated assets, or up to 100 employees. So in terms of thinking about using data, ASRS and ESG data to increase business value, there's a series of actions. It's really about creating a sustainable supply chain. Addressing the advantage there is to address your scope 3 reporting requirements and a more sustainable business model. Actions such as measuring, managing, and reducing your GHG emissions. Again, you're able to fulfill your scope 1 and 2 reporting obligations, but as we've seen as a company as well, those tender requirements frequently coming up in our functional requirements. What are your emissions and what are you doing to reduce them? But you've also got the advantage there of being able to reduce energy costs when you actually got the microscope on those costs. Implementing climate change adaptation measures. That can lead to business efficiency and future-proofing your business. Developing circular approach to product reuse, business waste and raw material waste. There's plenty of cost efficiencies and development or room to develop sustainable business models out of that as well. And finally, implementing the full suite of ESG policies, not just your emissions reporting, but your social and governance policies as well. Staff like to be employed by a company that's going to look after them and is actively engaged in these principles. Likewise with customers and investors. In fact, we just recently were discussing this with a potential client who is primarily focused on their investment company, who are looking specifically at companies' ESG policies in terms of what they're going to advise their companies to invest in. So really, really important here. And that's really what's going to create that competitive edge over your rivals, particularly for SMEs, as the slide says there. You may not have to report right yet, but to be seen to be ahead of the pack is really going to provide you with that competitive edge when a tender document is being reviewed and all of those criteria being met. But you've also got this, you're also reporting, and this can be a really important edge for you as well. So I just wanted to touch on a couple of case studies now to kind of illustrate what we've just been discussing. This case study 1, Glasscoat Industries. This is actually a recent data ESG project where we did a sustainability analysis for them. They're introducing a range of new technologies through a sister company, Sirion Technologies, and they're basically proposing a 700 tonnes per day low iron float glass company, plus a 400 tonnes per day waste to energy mega plant in Queensland, Australia. The challenge here was a glass company traditionally has very high emissions just by the nature of smelting glass. You're burning a lot of fossil fuels. So their challenge was to really reduce their emissions by 85%. So the solution was really to invest in that R&D with Sirion and develop these cutting-edge technologies and map out a strategy moving forward. And the results that we were able to affirm through our analysis, particularly the data, they started with a BAU, business as usual, standard glass furnace, roughly about 15% coloured being recycled glass. Then we moved through adding that ESG integration, oxy-fuel, regenerative burners, up to 50% carbon capture as well, reducing the level of emissions from BAU to 50%, and then integrating the full sustainability model using up to nearly 45% recycled glass, 95% carbon capture and renewables, and that led to an 85% reduction overall of their emissions. And that's now attracted 1.2 billion in total investment. In fact, they're going ahead now with that glass plant in Queensland, which is going to end up with a lot of jobs in Queensland and creation of many skill bases and knowledge across R&D and high-tech engineering as well. The other one, because I looked at the attendee list before while I was preparing for this, and noticed there are a couple of IT data companies who with us today as well. I use this, and I've actually used this in a previous webinar, just because it's a really good example of a data center company who achieved very high profitability through the implementation of ESG initiatives. The challenge really for them was that public awareness that we all have, high energy and water consumption used by IT companies, particularly data centers. Now, we all know the adage of, one AI prompt uses a glass of water for each prompt. So their solution was to integrate ESG principles right throughout their operations. So they committed to net zero by 2030 and implemented renewable energy solutions to power its data centers. They procured all non-potable water, that's recycled water. They had on-site water storage, conservation recycling facilities, and then they invested in the Jacaranda to Flame nature-related initiatives as well for nature and wildlife initiatives as well. So what they achieved was that 100% electricity from renewable energy, all the data centers now running on non-potable water, reduction in upper threshold water stress, and the 9 support activities for nature conservation. So the outcome for that, for AirTrunk, was the company achieved 94.8 million in sales revenue, marking a substantial year-over-year growth, and was eventually acquired by the US private equity company Blackstone for 24 million, increasing its valuation. And they were known because once Blackstone had actually acquired it, they actually gave their company employees, they awarded their company employees $22 million in bonuses across its 330 employees, averaging about 65,000 per employee. So it's a good example of how using ESG data and really taking a very focused approach to implementing ESG initiatives can increase profitability. I have asked about potentially for data ESG, whether we'd be in line for $65,000 bonuses for our clients, but so far nothing's come of that. Still working on it though. But at this stage, I think I might hand over to Shu, because he wants to talk to you about the way in which ASUENE deal with many of these issues, in particular how the decarbonisation platform can play an essential role in all of these processes. So over to you, Shu.
Thanks, Roger. I'm sure as you continue working on sustainability, your 65,000 bonus is on the way.
Thank you, Shu.
Okay. I would also like to thank the attendees for joining this session. Now I'll start on my part of the sharing. So because today's topic is on beyond compliance, I just wanted to start off with a key concept, the fundamentals of why sustainability is important in the first place. Now, sustainability is a single word, but it is very, very complex. And I always take my hats off to the sustainability professionals because within sustainability, you're not just managing compliance. You're looking at the company's long-term goals, medium-term goals, short-term goals, and somehow bring all of that together to marry that climate data together with the financial data to come up with a value for the companies. Now, when it comes to sustainability data, I just wanted to illustrate the importance of why we need to look at ESG data in a granular manner, using an illustrative example of how that is very, very similar to how we look after our health. Scenario A, if anyone wanted to lose weight, we have a whole bunch of people who just randomly starts going out, starts running, or just immediately stop eating. This is scenario A. Someone who want to lose weight by, without thinking, just going for a run, cutting the food. Scenario B, we also have a lot of people who measure the weight every day and then track the performances over time and then implement actions. So those likely to see better result than those who's in scenario A. Now, scenario C will be those who don't just measure the weight, they also start to calculate calories, protein, carbon, fiber balances, body fat percentages, and then plan the actions based on the data. Now, within sustainability, we always encounter companies in all of the scenarios. Scenario A, we still have a bunch of companies who says they don't need to do any sustainability reporting. They are carbon neutral because they have solar panels. Or maybe they switch off the aircon, so they think they're being sustainable. So these companies not have any quantified impact, and what they claim in terms of the value is not backed up by any data. Scenario B, these are probably more the companies that are meeting the bare minimum of the compliance. So they are measuring the emissions. They can show the year-on-year growth, but most likely the effort is done on an annual basis, comparing year-on-year, without deep diving into which site is contributing to larger emissions, what action is contributing to more reductions. Scenario C will be the companies that are ready to present data around which office is contributing more, which energy source is contributing to more emissions. And then the reduction efforts are monitored month on month. So you know the impact right away in terms of the initiatives. Now, if we go back to the example weight loss, we know obviously that scenario C will yield the best result. Within the sustainability, it is also the same thing. So the companies that have granularity of the data can tie their performances together with the impact, quantify it, and then plan a better actions for a long-term success, which obviously will lead to a business value in the end. Now, sustainability also is a journey. So many companies that are at infancy stage, they might start off with a compliance, which is also a great start. Just tick the box, have the minimally required reporting metrics covered. But as the company continue the journey, they realize that sustainability is a very, very deep topic. So it is not just about ticking a box, but how do you then analyze your impact, the emissions? What kind of target do you want to set? How do we start to engage our supply chain for more of a holistic impact within the industries? Or not only to measure the company's emission, how do we measure the emission of the product and services that we are offering so that our clients appreciate these sustainability initiatives more? So those are the companies that turn climate reporting into a business strategy. And then the companies that go beyond this might start to look at public commitments, getting the ratings, getting awareness about the sustainability initiatives so that they can attract more customers, more investments, and use climate reporting or ESG data into transforming the companies into being the leaders of the industries. Now, within the carbon reporting, to drive value, there's two different types of reporting. Number one, the corporate reporting of scope 1 to 3. This is most often the common sort of a reporting metrics that companies look at. Under the ASRS or any other climate reporting, we'll typically ask for your scope 1, scope 2, and then nowadays more increasingly common to cover scope 3. The idea behind doing the corporate reporting is essentially to do your annual health check of your ESG metrics. So you look at 12 months financial year period of your business operations and tie that together with your environmental metrics of your energy, GHG, waste, and water used. On the other hand, there's also a type of carbon reporting that looks at products and services specifically by doing a life cycle analysis of a particular product and tying that data with raw materials, what happens at the production, how is it being distributed, how long is the product going to be used for, and what happens at the disposal stage. Now, by doing this life cycle analysis, the companies can claim their product and services that are being offered is equal to how many CO2 emissions, which if the company is sourcing for a product to be more sustainable, will give a drastic advantage in terms of the offers. Now, in terms of the ASRS, I'm not going to talk too much about this one because Roger had covered it, but the essential idea of ASRS and why this is significant is because it's now bringing the concept of looking at ESG metrics together with a financial impact. And this is going to be standardized across international. So many other countries within Asia, as well as in Europe, is looking to adopt a similar concept of tying that financial impact with sustainability. So these frameworks are giving a great start, a great sort of a framework to analyze your ESG metrics and how that impacts the business operations. Now, we know why reporting is important, and perhaps most of you or some of you have been working on the reporting already. It is very easy to say that, okay, there's a reporting, let's do it. However, we all understand that climate reporting is very, very complex and it is multifaceted as well. So while it's a single word, sustainability, there's always issues around data, which is it takes so much time to collect, calculate, and check data because we have data sitting with HR, we have data sitting with the purchase procurement, we have data sitting with the infrastructure. It's probably sitting all over the place as well in terms of the business sites. And these data are often not in the same format. So you have some in kilowatt, some in a dollar, AUD, some are probably in terms of the distance, and probably sitting in all sorts of different digital ecosystems. And together with the data problem, there's also that knowledge issue. So regulations are changing all the time. How do we know that the method we are using for Scope 3 is correct? Whether the choice of emission factor we're using is correct? When we start to involve multinational operations, and how do we know that the methodology that we used to doing the local reporting will also apply, let's say if you have an office in Indonesia or China. So these knowledge problems also will continue to happen. And when it comes to sustainability, reporting is one thing, but it is actually very, very complex, multi-layered, and sustainability is not just a reporting job, but it is really about managing the complex organizational issues. So number one, to drive sustainability initiatives, we also have to manage change, which is number one, we have a lot of stakeholders sitting in different departments, probably pushing back on submitting data on time, maybe because there's an additional burden to their roles and responsibilities. It doesn't impact the primary roles. So the sustainability officials, the professionals, will always have to get the stakeholder buy-ins. And also when it comes to change, creating additional duties will also often require impact recognition. So quantifying the impact so we can reward those who have contributed to better sustainability impacts. And of course, reducing the mental barriers, burden, all of these key communications internally will have to be achieved to drive that change management. And then not only the change, we have to make sure that the process itself is sustainable. So there's that process management part, breaking the silo so the sustainability office cannot work independently, but must work holistically within the organization with other departments. We also need to manage stakeholder reporting, so making sure that the numbers that we generate are understood by the peers and the managements, and also going back to the data issue of having the data sitting in all sorts of places, different ecosystems. There has to be an efficient way to collect data and also a consistent way of presenting these reports. And all of these tie in together with the data management part, which is number one, how do we ensure the accuracy of the data we collect? Second, the reporting that we do, how do we know that it passes the audits or the third-party assurance, which is going to be a key part of ASRS as well. And then also not just collecting the data, but after we collect them, how do we analyze them? How do we put a meaning to these numbers? And what kind of target do we set? And how do we track our performances versus that? So all of these managements are managed by sustainability professionals, which makes the reporting duties extremely difficult. So at ASUENE, what we are offering is actually a unique value, a concept which connects the platforms, which is designed for easy, efficient, and accurate reporting, together with sustainability consultants who's going to be engaged in a monthly consultancy to make sure that the platform is configured, set up in a correct way that works for every organization. So if we connect it back to the ASRS, then essentially we are trying to solve the issues about auditability, covering scope 3 methodology comprehensively, minimizing the errors from the data inputs, providing a gap analysis. So we can also provide consultancy around the role mapping, target setting, and all of that coming together to really solve the issue. Now, I would also like to share a bit of a case study about how we solve some of the company's issue. So this is an example of Sony, who's obviously a global conglomerate. They have offices around the world. The challenge number one is they have an internal data that they need to collect from 1,000 plus offices. The challenge two is not only internal data, they also have to collect external data because they have 500 plus key suppliers. Now, these are only key suppliers. So in terms of the actual number of suppliers, it goes in the thousands. And even 500, which is just the top few percentage, is already a large number. And the challenge number three is Sony. Most of us probably associate a company with electronics, but they are actually a conglomerate that are diversified in terms of the business offerings, including the investment arm, the venture capital as well. So when it comes to Sony's CVC, the venture capital arm, they also make ESG investments. So it is extremely important for them to be able to assess the ESG ratings of each of the investments that they're making. So the solution we bring, number one, is making sure that there's a tool that allows for the multi-user access and data entry to be done at ease by each of the offices without someone having to centrally manage and collect all of the data via email and then putting all of that together manually on Excel because that can be very time consuming, creates rooms for errors. And solution number two is this data collection effort cannot just be limited to internal data, but it also needs to foster data collection from externals. So our platform allowed Sony to collect data from the suppliers to key in the data directly, which then can flow back into the dashboard as a scope 3 data collection. And solution number three, in order to facilitate Sony's assessment of the ESG investments, we had a module or a function to help them collect data around environmental, social, and governance and automatically ingest a rating, as well as to flag up some of the risk items that are sitting within the investments. So the outcome, number one, is really about building that value from error minimization and time savings so the sustainability office can actually focus more on the impact rather than the data collection. The outcome number two is, of course, the scope 3 data accuracy has improved. And I think most of us probably are aware that for scope 3, if we stuck with a methodology of going by the spend, then we are never going to reach that target of net zero because your spend is likely going to be increasing based on inflation, or as the business expands, it's going to increase. So the key and the most critical thing about your scope 3 reduction is really about data improvement so that we can collect supplier-specific emissions data. And as your suppliers work on emissions reduction, that can also be accounted for as your scope 3 reduction. And the outcome number three, ESG rating of the investees, were done more systematically. So they can collect data annually, do the ESG assessment, analysis, the scoring, so they can track the impact of the ESG investment itself as well. Now, when it comes to other case studies on driving the value, the product carbon footprinting of the products and the services that I mentioned earlier is also a great way to start in quantifying the impact of the emissions reduction. So logistics and transport is often a sector that constantly requires carbon reporting or constantly are being pressured by the customers to generate carbon reports because there's an independent category of the upstream and the downstream transportation. So many of the logistics and transport companies nowadays have been early movers in adopting both the reporting solution as well as to make sure that they can provide sustainable options. The issue with the sustainable options in the past was that logistics company may say that they have an eco-transport, sustainable transport, which often priced much more expensive than the regular because they had an initial investments into probably an EV or other means. However, most of the customers if they just compare different options, regular transport, eco transport is more expensive, it becomes very difficult to justify without the actual evidence. So by doing the product carbon footprinting, doing the scenario A, the usual method, conventional, scenario B, if we had switched out any of the assumptions into something that's more sustainable, in this case, instead of a long distance truck delivery, to insert the railway, it had generated 90% savings. Now it gives confidence for clients, and the clients are willing to pay more premium because they are measuring the carbon emissions and claiming that reduction from the sustainable procurement policies that they have is important to them. So this is one way you can drive a business value and make sure that the products and the services offered as a sustainable option can also be understood by the clients with an actual evidence. Now, another study or another case study that we are working on is actually in South Australia. We are working with South Australian government, also the Australia Grapes and Wine Association, as well as AWS, to do a case study of a wine products, essentially to put a label saying wine, this bottle of wine equals to how much CO2. The entire concept and the idea came about as the international move towards carbon border adjustment mechanism. So maybe some of you have heard of the CBAM, maybe some of you have not, but CBAM is basically this new regulation in Europe that if any of the imports happen for certain categories today, which will be metal, steel, the importers will have to pay a carbon tax for the products that they're importing. Now, there was a rumor that wine might have been added to the list because obviously wine is a very popular product that comes from Europe, and Australia, America, those are the biggest rivals for European wines in terms of the international markets. So the idea and the rumor came about because EU had recognized that Australian wine might put an additional pressure in terms of the global demand. So Australian Wine Association had decided that the industry needs to be ready to be able to present the CO2 emissions coming from wine production in Australia. So if in case the EU have come up with a CBAM for alcoholic products, then the industry will be ready. So where we came was really to provide a solution that allows each supply chain partners to key in the data directly, which gets aggregated as the process goes to a final product of having that CO2e. So the idea was really to engage and onboard grape growers, the winemakers, the packaging providers, the transport distribution companies by providing an educational workshop, trainings, giving them an easy to use platform to simply put in the data that gets converted into the emissions, and also to work as a data exchange. So as the process goes, the next suppliers involved in the process can easily pull the data and then aggregate that into the sum. So now, in terms of the case study, that was essentially how some of our clients have generated the value in the business by working on sustainability initiatives. If any of these topics have piqued any interest to explore further in terms of our capabilities, I have put in the contact details here for you to note down, and please feel free to reach out to either of us to arrange a session for us to share more about the solution and potentially how we can support further.
Thank you very much, Hugh. That's really interesting. Maybe we've got some time for some questions. Might just kick this off. I mean, that's a really interesting idea, isn't it, to actually look at emissions of a product as you're actually developing that product. I guess that goes to marketing too as well, Christine, in terms of what you can do with that type of data with a new product, given the emissions that product's actually created in terms of emissions. It's
definitely this is one of the ways where the companies can create a competitive edge. So even the SMEs now, when it comes to working on sustainability early on, can actually win tender versus big corporates. So one of our clients in logistics and transport, which is an SME, has won a tender, one of the largest retailers in Thailand, to for the global. They were the only one who was
Yeah. Unfortunately, I don't know if anyone else was affected by that, but couldn't your signal sort of suddenly starting to drop? Christine, is that for you? It might just be my
Yeah, I did experience that. She wasn't overly clear.
Yeah, we couldn't.
Oh, okay.
Oh, that's better.
That's better.
Oh,
Do you mind having another go at that, what you were just saying?
Sure. Yeah, so I was saying that working on sustainability is definitely an area where SMEs still have a room to win versus the global corporates. Because one of our clients in Thailand, a very, very small SME, logistics transport company, have recently won a tender from the largest supermarket retailers, grocery retailers in Thailand, even against these global MNCs like FedEx, because they were the only one who was ready to present with a sustainability report.
Interesting.
I mean, when it comes down to those tenders, and you've shortlisted 3, and they're all really good proponents of that particular tender. Then it comes down to what? Well, it comes down to something like this, isn't it? And that's what you're just talking about.
Yeah, definitely.
Got any other questions, anyone?
Well, we'll be sending through the recording as well as Roger and Shu's details. So do please reach out for a demonstration, further information. You have our email, so we've got our website. There's all our information on there as well. So any questions at all before we wrap it up? Or Roger, did you want to add anything to this presentation?
No, other than to say thank you all for joining us today. If you want a tailored presentation of ASUENE, we're happy to provide that. Just get in contact. So we, DataESG, do a lot more than just implementation of technologies. We're research, strategy development as well. But look, thanks for joining us, and we'll see you all soon.
Thank you. Thanks again. And you'll hear from us soon.
Thank you all.
Thanks. Bye.
Hey, and then there was just 2 of us.